Welcome to the Grow Your Practice podcast. Hi, I'm your host, Chad Madden, owner of Madden Physical Therapy and Breakthrough. Join me each week as we dive into the best practices, systems, principles, tips, and tricks to help you grow your private practice. Everybody, Chad Madden here with the Grow Your Practice podcast. And today we have a very special guest, Sean Healy. Sean is founder and principal in Accounted4. So welcome to the podcast here, Sean.
Appreciate you having me, Chad.
Awesome. So I know that you work with a lot of private practice owners, and just in a little bit of the conversation that we had beforehand, you've been doing this for a while, and I know I think I saw you worked with Jamie Schreier and Will Humphreys and Steve Mountain, some other friends of the podcast. So how'd you get started with Accounted4, and exactly who are you working with in private practice, Sean?
Yeah, so I mean, at this point, we niched a couple years back and really just found that our model mixed really well with private practice owners. Come to find out, if you go for all these different years, to college trying to get this degree, and they never give you a single business course the entire time. So we found that different pieces of our model blended really well with the industry. What's interesting is this all started about 8 years ago. I was a director at an accounting firm at the time, and it was funny. I actually had a private practice owner I'm sitting down with, and I remember they asked me this really interesting question. It was, am I making money? And what was interesting is I got asked to do a lot of consulting with this client. Now, I was a director in an accounting firm at this time. The partners were, meeting with this client regularly. And for whatever reason, the answers that they were providing on this question were just not sufficient enough. And so after asking him, a lot of times what they would do is they tell him that you're making profit. They'd show him the P&L. They'd explain how you can cut some expenses. What he was actually asking is, why is my bank account not the same? So why am I being told I'm making profit, but my bank account just doesn't change? Why am I profitable, but I'm struggling to make payroll? My credit card debt is getting higher and higher. And it just kind of opened up, this whole idea of business owners think in terms of cash flow. They don't think in terms of profit always. Profit is kind of an accounting terminology. EBITDA is the language of finance professionals. Cash flow is the language of business owners. And what's in your bank account is generally kind of the most important piece of the puzzle. And so the question he was asking, he was getting an answer to not the question he was asking. And what I realized, fast forward, eventually figured, I think this is a problem, in my company. And then after talking with hundreds of other accounting firms, CFOs, CEOs, you name it, found out that this is actually a translation gap, almost like across the board. And the typical solution that most CPAs provide has usually a lot to do with taxes, usually doesn't touch on cash flow. So from there, we started building more or less a service out. We started building different technology out, and started realizing that the only way that we can solve cash flow problems is to be able to provide proactive, predictive reporting. Once you have predictive reporting, you can make decisions ahead of time versus reactively, which unfortunately is really kind of the industry norm right now. So it really has progressed over the last 8 years since that conversation, but that one question, really opened up and kind of sent me and now my team down a rabbit hole, that's kind of led to Accounted4.
Love it. I'm glad you shared that story. Over the last few years, I think we've worked with over 3,000 practices now. Many times I'm having a one-on-one conversation just like you had 8 or 9 years ago. And the owner will say, oh, I'm doing really well. And like the narrative doesn't make sense for me. And I'll say, oh, how do you know you're doing well? And they'll take out their phone and say, right here. And I was like, well, yeah, what are you looking at? And yeah, exactly right. They open up their app with the business banking account, and based on, I mean, they're basically looking at it like the stock market. If it's up or down in a day, that dictates how they feel. And they're not really understanding okay, this is a balance sheet, this is a cash flow statement, this is her income statement, and how they should be thinking about that. So great. I'm an owner. I grew up in the cash pay world, or like thinking about my accounting for the P&L and also doing a pro forma in terms of cash. There's also accrual accounting, which is a whole new world for me that we've really dove into. What's the first step for most owners who are, guilty as charged? How are you doing financially? They're taking a look at their bank account. What's the first step or two that you walk them through to help them get a good grasp and some education awareness on how their practice is doing financially?
So step one is you got to know where you are today. So think of it like a GPS. If I don't know where I'm going and I don't know where I am today, it's kind of hard to build any type of a plan or give any type of an insight. So if I'm a business owner and I know where I am today, which is a great first start, step two is where am I heading? What are my goals? Because if all of a sudden your goal is to retire in 5 years, but you're 10 years out, then we have to make vastly different decisions than if you're already have enough put away to be able to sell the practice. It really depends on what you want out of the organization. And you need to be able to define those two pieces to start. The piece after that is you need some type of predictive analytic to be able to say, based off if everything stays the same today, which direction is my company heading? So once again, if I know where I am today, I know where I want to go, how long is it going to take me to get there? Most individuals, most professionals, even most accounting and finance professionals that do advising tend to focus very much on let's look at your financials after the fact, which don't get me wrong, is great. And you have to be doing that on a monthly cadence at the very least. But the problem is if you're not looking forward, it's the equivalent of driving your car by staring in the rear view mirror. You're eventually going to crash, right? So it's having some type of a look into the future to make sure that you're on the right path. And if for whatever reason you're not, it's giving you time to be able to make those changes to get back, onto the right path or get back onto the highway so you can get to your end goal as quickly as possible.
Cool. So many practice owners, they take a look at either the bank account or the P&L, right? And that they're getting that P&L like 90 days after the period is closed.
Yeah.
So it's either monthly or quarterly, or sometimes they're only looking at it once a year annually to see where they're at. And you've said that the balance sheet matters even more. Just to give you some props, I know Warren Buffett, and because I'm a nerd, I've been reading, I went back through 1965 and I'm reading the annual reports. He says the same exact thing, that when he's analyzing the financial health of a company, the balance sheet is most important, even above some of the other statements that might be available. So he looks at that first before PE ratio or anything else because it represents change. Keith Cunningham says the same exact thing in The Road Less Stupid. I think it's Keith Cunningham's book.
I think I read that one before, but Road Less Stupid. I'm gonna have to look.
Yeah. I got that from another owner who just is high school education, never went to college or never graduated. I don't think he completed his first semester, owns a very successful business. And I said, "Oh, how did you learn business finance?" And he said, "The Road Less Stupid." So but they both said exactly, or something very similar to what you said. So can you break down why that is? Why is the balance sheet more important? And how can an owner learn how to read a balance sheet?
So let's go back to that conversation I had 8 years ago. Am I making money? Right. What's being asked is more money coming in than is going out? Right. Am I making more money than I am spending? Is really what the question was. Problem is when you look at profit is just your income minus your expenses. There are a lot of things that land on the balance sheet or whenever there's a transaction will impact two different areas of the balance sheet, but don't technically impact income or your expenses. So the common misconception is if I spend money, it's an expense. But there's a lot of different things you can spend your money on that are not expenses. So examples would be if you pay down debt, that does not go on your P&L. Owner compensation, most forms of owner compensation like draws, distributions, does not go on your P&L. Taxes that you pay for most companies that are, under 10, 20 million, most companies are set up as pass-through entities. Taxes, that does not impact your P&L. Same with when you buy assets or when you're saving money. So what happens is, what people don't realize is profit is really just the start of the equation. You need to budget and plan just like you do for your profit to figure out where you're going to land. You need to make enough profit to get to those five goals. How are we going to pay down our debt? How are we going to compensate ourselves as owners? Are there any big assets we got to purchase? What are our saving goals? And how are we going to save for taxes? If you can make enough profit to pay for those 5 things, that's how you have a cash flow positive business. Problem is, most finance professionals tend to look at profit or tend to look at EBITDA, completely ignoring the balance sheet.
Yeah. Just anecdotally, I have a good friend. We have lunch at least once a month. And this is outside of healthcare altogether. So It's very easy to third person this, and he'll never hear this as well. But we were at lunch and he was like, and he probably has done the best job executing advice that I've given than anybody that I've ever personally mentored. Grew very, very quickly. I forget what he told me. It's an 8-figure business, 8-figure revenue. And he said, I'm not making any money. And so we're going through, and it's where is his money going? Number 1, you nailed it, was debt repayment. Number 2 is he's running a ton of personal expenses through the business for tax purposes, like vehicles, education for the family, things like that. And when it was all said and done, I mean, he has a very healthy, high 6-figure take from the business, but there's nothing left over after that when he also has to pay taxes. And he was kind of devastated. And I was like, man, you're highly leveraged. You have this amazing lifestyle that is fully supported. And at least you're breaking even. You're not having to take on more debt. It's a pretty good deal for what you're doing. But here's how you need to think about this in order to actually create some. He was thinking about selling parts of his business just to have cash available because he feels like he's on thin ice, that he doesn't have much of a cushion. The other thing that I'll share is I'm very, very caveman-like as an owner, as I know many of the other owners that you work with probably are in our financial understanding.
Please define that for me.
Years ago, I read Richest Man in Babylon, and and then followed by 25 Forms of Rich Dad, Poor Dad, all by Robert Kiyosaki. But very, very basic. That's what I mean by caveman. And the one thing that was in Richest Man in Babylon is for every 10 coins you make, reserve 1. And thy purse will fatten, I think is the phrase or the little saying. So not knowing any better, when I started in practice, every week we would take 10% of our previous gross week's collections. Again, I was operating on cash, not accrual, and I would just put it in the bank. What happened is we had this huge war chest over time because I automatically became profitable, like at least 10% profitable, sometimes significantly more. And it also kept me from eating everything that I was making immediately. But then when we went to buy assets, like you were mentioning, equipment, adding space, bringing on another clinician, buying a building or anything like that, we had that war chest of asset money to deploy. And it worked out pretty well. So the other thing that you mentioned was predictive indicators. Can you talk about what they are, and maybe mention the top 3 or 5 vitals that a practice owner should be looking at as a leading indicator or predictive indicator that they should be looking at every week or every month rather than their Bank of America statement?
Yeah. So the funny thing is, if you're ever looking at any type of financial statement, it is always what they refer to as a lagging indicator. All right. So unfortunately, with accounting, you are literally accounting for what has already happened. So if you're ever going to look to make decisions, you're making it well after the fact where you can't actually impact that with some type of a predictive indicator or lead indicator, which if you've the 4 Disciplines of Execution, I don't know if that's a book you ever read. It's like my number one. Looking at the bookcase.
Yeah, I'm pretty sure I have it. Yeah, it's right here.
I think it's a go-to of mine. Once a year, it's fantastic. One of the biggest things they talk about is finding good leading indicators of success. So in private practice, some of the basic predictive indicators that I tend to look for is how many visits do we have scheduled next week? Right? Because if all of a sudden we know that we have a 10%, cancellation rate, well, if we want to hit our maximum, maximum efficiency, we need to make sure we schedule more than you have to schedule 10% more than what you think you're going to need. And if you're not scheduling ahead of time or you don't know that number proactively, you can't do anything to start filling in the gaps in the schedule. So that's a simple one. One of my favorites is whenever you have your like that initial visit, right? Whenever somebody comes in for that first time, they leave with that plan of care. How many visits did they schedule before they leave? A lot of people do is they'll schedule the 2 or 3 visits for next week. But if they're not scheduling out the entire plan of care, you're generally missing the boat. You're not hitting the full plan of care. There's usually a lot of drop off. So if you just track how many visits are scheduled after, an initial evaluation, if the answer is we're not tracking it, then how do you know, right? So it's what it is. It's a leading indicator. We can track after the fact of, well, what's the average plan of care? What's the average dollar per visit? But if we know that, let's say, somebody at the front desk or the doctor owns how many people or how many visits are being scheduled by the time they leave, it's a predictive indicator of future success. Those are 2 of my favorites. That they're not always predictive indicators are not always the easiest thing to track, but they tend to be the most impactful.
Yeah, I'll want to validate you there. I know you're in the Philly area. I had a mentor in the Philly area, Jeff Ostrowski, was with Excel and Apex, and they had a huge practice, I think 33, 35 clinics. And I remember talking with Jeff and some of Joe and Todd and some of the other principals there. And they did this same exact thing Sean called active schedule record, I think was the name of it. But they were looking at exactly what you're talking about. And that helped them deploy resources and help them make really smart management decisions. But they were doing exactly what you were talking about, looking ahead. I'm going to say that 98% of practices never think about that. So everything, exactly like you said, is a lagging indicator. I did have to grab the book. I remembered Wiggs, Wildly Important Goals. But it's been a few years since I read that. But yeah, we can link that in the show notes for everybody. But it's 4 Disciplines of Execution, Chris McChesney, Sean Covey, Jim Hulling as well. So we'll link that out for everybody. But yeah, love what you're saying there. It's completely right. Most practices do not look ahead and they never think about scheduling the full plan of care. And we've been promoting that for 10 years. Like, you want the full commitment from the patient leaves, they're future pacing, they're thinking about how they're going to do their 8 visits, their 12 visits, 20 visits, whatever it might be. And it's a much cleaner way to do business than scheduling visit to visit or week to week.
Yeah. I mean, it's difficult to track sometimes, though. And as I said, it's something where once you do it, there needs to be a certain amount of accountability around tracking it, reviewing it. But once you have that heavy focus on, and if you can identify specific predictive indicators in your practice, it's amazing the impact it can have on the ending financials.
Yeah. In your origination story, you mentioned like the owner who said, am I making money? And they didn't understand how to look at that. I'm going to guess that the number one financial stress that we've all gone through, any owner that's listening to this right now, is I have payroll to make on Friday. It's $50K. I have $37,000 in the bank, and it's a cash flow crunch. How should owners be think? And then we vowed, like, as soon as we borrow 10K or whatever it is that we have to do to make payroll. I'm never going to let this happen again. And then 3 months later, we're doing the same exact dance. So what are some common mistakes that, owners make that really choke cash flow, and how can they prevent them?
It's not necessarily mistakes that they make. So let me start there. A lot of times, once again, if you don't, there's kind of a big gap in just the small business industry, and it's not just private practice, it's kind of across the board. There's a lack of tools and resources to be able to look forward and make proactive data-driven decisions. So if you don't see that you have a biweekly payroll in 2 months, and on the same day as payroll, you also have rent, you also have that quarterly bonus structure that, we implement to try to drive behavior. We also have, that one annual subscription on technology, and they all land on the same day. You can have great profits. You can have good cash flow. But if everything meets at the same time, and it's like, oh, and I just paid myself, we had so much in the account, so I took 10,000 for myself, right? If all that happens all at once and it's not intentional, that's when a lot of times it's just timing, right? And especially if all those meet come January, where I don't care how good you are at projections. Everybody hits like 85% of projections every January, between weather, between flu season, between like you name it. There's certain times of the year that cash is going to be tight. There are certain months where you're just not going to collect as much because there's not that many business days in the month. Knowing where those fluctuations are and planning ahead of time for them is not easy to do without good tools, right? I think one of the hard parts that it can get confusing is having that cash flow budget opposed to just, I know my profits. What are we going to do with it intentionally? So I think it's not as much that they're bad mistakes or bad, it's not as much bad habits. It's just a lack of information. It's going off of their gut feeling. And a lot of time it's making decisions based off of what's in the bank account, even though in 4 days, there's not enough. The solution tends to be, when we talk about saving strategies, one of the biggest saving strategies we try to push people for is level 1, save enough for one payroll. Because what's our biggest fear, right? You got to put reasoning behind why we're doing some of these savings and making sure that are we bringing enough profit to pay down our loans, to be able to compensate owners so that it's, they're not stressed out financially. Owner, what is it? The owner's the last one to eat. They still have to eat. So we have to budget that in, right? And then after that, it's making sure we're saving for taxes, but it's also making sure we're saving for like strategic items. If we know that we have a 3 payroll coming up in a few months, it's putting a few $1,000s aside into a savings account now so we can pull it out, that particular month we know we're going to take losses. Once again, it's more that having the right tools and having the right resources to be intentional around what we do with our money, opposed to doing it based off of, a gut feeling or a bank account.
A lot of whimsical decisions for sure. Yeah. And just huge disclaimer for everybody. I'm the one that said mistakes. Sean did not say mistakes.
Hindsight's always 2020. It's
yeah. I would call some of the things that I've done definitely mistakes, but fair enough. So the one thing that I've talked about at association events for a while now is, like, every year I go through the cms.gov site. I take a look at the physician fee schedule. If we're mapping out reimbursements since 1994, reimbursements here in 2025 are actually lower than 1994 when I was a junior in high school thinking about becoming a PT. And if you would have told me that at the time, because there's no adjustment for inflation, I might have thought differently. Now I love what I do. I get to help a ton of people. We see 10,000 visits a month in practice, and I get to work with other practice owners. So that is absolutely amazing. But it's definitely a pretty tough financial environment to work in, where we have declining reimbursements over time, down 17% since 2008, and we have the increased cost to provide care. What trends are you seeing in the market financially with the practices that you work with? And is there anything that you see coming down the pipe, like with AI or anything like that, in the next 6 to 12 months?
Okay. So there's a couple really interesting stats, right? The stats we tend to throw out there, and this is so it's funny. I every once in a while I'll try to include our clients, like executive teams, in on this conversation. Roles have decreased by about, I think it's 10% over the last decade. So a lot more over, since in the time frame you were talking about. There's an economist I just heard was predicting. We just had a Vistage presentation, and we had a speaker come in, and they were saying that they think that labor is going to increase. The average labor rate is going to increase by about 28% in the next, I think it's like 5-6 years, right? There's the good news is it's already been increasing at a pretty rapid rate, and private practices are still in business. All right. So the hard part right now is it's shifting the model, right? So a lot of the things we're starting to see, people are starting to replace administrative staff, right? It's using virtual assistants, right? It's utilizing virtual front desk, right? It's adding some of that automation in. We're seeing people using AI to be able to do some of the note like dictation, right? It's being able to remove some of that admin time, start actually filling out the paperwork automatically, right? With some of those different tools and some of those different approaches, you're not putting all that money into administrative costs. You have the ability to compensate your doctors. You're able to compensate the people that are really making you that money. And a lot of times it comes down to making sure that you're outsourcing at the right time, or that you're just driving as much efficiency as humanly possible. Those are the things I think that are all starting to happen. I think if some of the economists are correct, the individuals that don't implement those are going to be the same individual that, how every company has that one person that wants that paycheck. They can go to the bank and drop it off. And it's like, why would they do that? Little by little, we're starting to hit a point that we have to start thinking outside the box, right? Because giving less care or worse care is really not an option. It's how do we transition to more capital? How do we transition away from some of the insurance companies, or at least start dropping some of the lowest ones? And how do we start making more efficiencies? And, if a doctor is going to be working for us for 40 hours, how can we get the biggest bang for our buck from that individual? And making sure they're giving a great plan of care, because that's a non-negotiable, but do it for a rate that we can continue to pay the bills, we can continue to grow the company, and we can continue to provide employees with a place that they really want to work. It's not easy, but it's 1000% possible. And we're starting to see a lot of these different tools being implemented, and the ROI can be significant, especially when the team and the employees actually buy in that, yeah, if I don't have to do any of my paperwork and AI can do it for me, I'll just go see a dozen more a week. And you're like, that right there pays for, that one employee that pays for the whole thing. So the dollars are real when it comes to implementing some of these different options.
Yeah. And I just want to back you up there and validate that as well. We've rolled out, so we're a USPH partner. I think everybody on the podcast knows that, with my private practice. And so we rolled out through USPH and Raintree Prediction Health in one of our practices.
Yep.
Crushing it. I think it's called Scribe or Scribe AI, something like that.
Yep.
Absolutely amazing. We also here at Breakthrough, Carl, the CEO, and the engineering team, they developed an AI agent. Ours is named Emily, but can respond 24/7 to text and online ad response. So we have, record, and she also converts at 8%. So this is cold traffic over to an appointment. That is unreal. So if you think about what we're trying to solve, we have a marketing team, and the marketing team has priorities. So if we can take one of those priorities where even at their best, they can only answer calls 40 hours a week, right? So if somebody, like the one example was 12:26 a.m., an inquiry came in, somebody responded to an ad. Emily had a 13-minute text conversation. The person who responded, the potential patient, thanked them and then scheduled an appointment. And we could never do that, even with via, virtual assistants or anything else. So what it allows our marketing team to do is become more highly focused on other priorities. So they're slightly redeployed, and they have one less thing to worry about. So we're streamlining those things and helping those, that team of 2 or 3 become really exponentially more productive. Pretty smart stuff, Sean. And a couple more questions here, but before we get into this, if somebody wants to learn more about you, who is the average practice that you're working with, and how do they reach you and your team at Accounted4?
Yeah, so the average practice size is generally between like 1 and 15 million. I know that's a really big range, but
1 in 15 million annual revenue.
revenue. So we have a good chunk. When we first started, we had a good chunk of clients in that 1 to 4 million range. We have a few that are smaller, so it's not it has to be the right fit at that point. We had a good chunk of clients in that 1 to 4 million space, early on. And we started realizing with a lot of the tools and resources that we offer that the model ended up working really well with clients up till that like 15 million marker. Once you're over that, it's not that we can't work with somebody. A lot of companies want to start hiring a full-time CFO to be able to, be in the weeds every single day. Our model's still on the fractional side. But to get a hold of us, find us on LinkedIn. That's always a really easy way. You can always go to the website or reach out to Keith Campagna, who I can provide some information on how to get a hold of him.
What's your URL? Your website, Accounted4 LLC?
Yeah, Accounted4, the number 4, LLC.com.
Awesome. Cool. And on LinkedIn, where should they go?
Just look up Accounted4 LLC.
Okay, great. The one thing that you mentioned in a few different places is helping owners exit. You also talked about it in the beginning of our conversation here. This is very near and dear to my heart, only because it's probably the number one request that I get from owners in like a private message. Like, hey, I just survived the pandemic. I'm ready to think about in the next 2 to 5 years, I want to exit. What do I need to do? I've gone through this myself, both with an internal sale of my private practice and then a fractional internal sale over years since 2012 through 2022, and then ultimately becoming a USPH partner. And my deal's public and everybody can see it, and I've talked about it here before. I know the prep work that went in. So both for me and my partner psychologically.
It's a full-time job, right? It's a full-time job.
It is wild. And there's not a book or anything that I've read that like really prepared me for what we went through. At the same time, I'm, popping out on the other end, extremely thankful that we went through the process. So as you're helping an owner, you have somebody come to you and they say, hey, I'm thinking about getting ready to sell in the next 5 years. What are the first 2 or 3 steps that you're walking them through for them to get ready? Because the other thing that I want to say is there's like a magic number, and I'm not sure what's going on here, but like a lot of owners will say like, I want to walk away with somewhere between like 1.5 and 3 million. And like almost everybody walks away with that, and they don't really think about it from the buyer's perspective. They think about it from what's in this for me as I exit.
Yep.
And they're wild conversations to have. Where like if you're going to go sit under the mango tree and you're your only provider, you're probably not going to get 1.5 million for your practice. So yeah, if you can talk through that, that'd be awesome.
So question number 1 that we always ask is why? Why do you want to sell? Knowing that and can help us in a lot of different ways. Are you running from something? Are you running towards something? Do you want some investment so you can grow strategically? There's a lot of different ways that, a really large cash injection or some type of an acquisition can really drive growth in an organization. It depends on what the goals are first. Then from there, my favorite question is, how much do you need to sell the practice for so that you can retire? Or to meet your retirement goals, right? It might not be the end retirement goal, but how much do you need to sell the practice for to get to your goal? Most people don't know how much money they need to be able to retire. So we try to have that conversation as proactively as possible. Because if you're like, I want to sell it, I think I can sell it for 5 million, but you need 10 to be able to never work again. Maybe it's not time to sell your practice yet, right?
Yeah.
So it's making sure that they're making the right decision for the right reasons, and making sure that what does the business need to look like in order to get that type of a number. And usually what happens is when you back into it, it's either, oh, that's reasonable and I think I can get the company there, or I'm already there, right? Or it's, I don't want to go and hire 20 more doctors. I can't even find one, right? So it's making sure that we outline what that path looks like to get to that, whatever that acquisition number is. From there, it's starting to clean up all your books. It's making sure that your books tell the right story. It's making sure that you're tracking all your EBITDA add backs ahead of time. I literally met with a buyer earlier today, and we were laughing about this because he's like, I'm just going to keep sending people your way. If you track all the add backs and I don't have to do that, that's fantastic, right? It's making sure you have a good, clean EBITDA line. It's making sure that the numbers are telling the appropriate story, not necessarily the tax effective story, right? Because sometimes they can kind of conflict a little bit. So you want to make sure that the story your numbers are telling is the same story that you're going to tell and show a buyer. You want to show valid numbers, and if there's any discrepancies or questions or anything that's off, it's not that you can go back and clean those in prior years. Once the tax return's done, that's the stamp of approval, right? There's no changing your books after that. But it's making sure that you have backup documentation to be able to explain to a buyer why your organization has low risk and high upside. It's being able to really put a lot of documentation in place to make the buying process that much easier, because the financials are only a piece of the puzzle of selling your company, as you know, Chad.
Oh,
But it's a rather large piece, right? So it's one of those where, how proactive can you be around how you're managing your data? And is your data telling the story that your numbers need to tell? Because if you're just throwing a bunch of personal stuff in it constantly, which you're allowed to a degree, you are allowed to do, it's sometimes not helping your cause. So it's just basically walking through a lot of that and making sure that all that is buttoned up.
yeah. So it's been some time since we did an exit conversation here on the podcast. So just to clean up a couple things, if you're listening to this and you're new to the thought of exiting, most of the time your practice value is EBITDA, so earnings before interest. Let's see if I nail all these, Sean. Interest, taxes, depreciation, amortization. So that's backed out. You'll have an earnings number, and let's say you're running a $2 million rev practice and your EBITDA is $400K. You then have a multiple, and that multiple is really a reflection on certainty of future income flows, and also the size of your practice. So, a 400K might be a 5 multiple. A 4 million might be 10, right? And there's a sliding scale there based on size and certainty of revenues, based on where you're getting your new patients from, other factors in the business as well. So if it's 400K with a 5 multiple, that practice would be worth $2 million.
Yes.
Right. So yeah,
With,
go ahead.
With one caveat. A lot of times that is done, your valuation's completed off of something they refer to as an adjusted EBITDA, which is, if I'm a business owner and I'm taking out just a ton of money for myself through payroll, and if you're to buy my practice and you don't want me, you add back that salary. And if my car is being run through, my lease is being run through the business, you can add that back in. So it's basically saying, what are all the expenses that a buyer wouldn't be purchasing? What does the company really look like if it was to be sold tomorrow? So there's a couple extra steps that I think a lot of people take very reactively. Whereas if you do it proactively and document, it just helps raise that EBITDA, raise that valuation, just simply by documenting things appropriately and proactively.
Yeah, I think that's very wise advice. I've never gone through a conversation, an M&A conversation, where that wasn't part of the deal.
Yep.
And I know we had completely cleaned everything up. No more Rivian or Tesla or Lamborghini or Ferrari running through the business. That I'm joking around about that, but
just for
I know most of us have run a car through a business at some point or another. But yeah, same thing with like if you own a building and you've done something wonky with the lease and it doesn't reflect fair market value, you want to clean that up for the buyer.
We have a list of different things that we tend to run through. A lot of times it can be rather extensive, depending on the company that you're talking about.
Yeah, great. Final question, Sean, for you. Most influential business book that you've ever read, is it 4 Disciplines of Execution?
Ooh, I'd probably say, yeah. I think 4 Disciplines is the one I read every single year. I'd probably say the only other one is Never Split the Difference.
Chris Voss.
Great book.
Here's a crazy story. We mentioned that AI conversion agent. That's what we trained the AI on.
Cool.
So, yeah.
That's a dangerous AI agent.
Well, so we pulled data from literally tens of thousands of phone calls. Many of them I listened to myself. And what most practices do is they have a script. So we're the premier provider. We provide high quality of care. With these services, whatever they're talking, we have these certifications. So they're constantly focused on themselves. That does not convert. But do you have any pain sitting here right now, Sean?
Always. I'm a rugby player. The answer is yes.
So what's bothering you the most today?
The knee.
Which knee? Right, left?
Right.
Right. How long has that been going on for?
10 years.
10 years. What happened when it started?
I was told to go to the doctor and I did not.
Okay, great. But you injured it while playing?
While playing, yeah.
Okay, and you got hit, or it was non-contact and
contact.
Just run?
Contact.
Got it. Okay, so the only thing that I did there was I asked you 5 what or how questions. Chris Voss refers to them as calibrated questions. So we see when people schedule an appointment that the practice asks basically a series of 10. We've boiled it down to 10 calibrated questions, begin with what or how, and that wins every single time.
I love
you can do it in text, you can do it in email. Next, the team is building voice right now, which is wild about how good that is. And as practice owners, we typically think it's like that it's like a bot that it doesn't really respond to what you're saying. It just asks something scripted, and that's not true enough. Anyhow, enough about that.
I love the application of that. Extremely.
The other, so cool stuff there. 4 Disciplines of Execution. I'll find you in the world here, and I'll have something for you. But Sean Healy, thank you so much for doing this. This was awesome, man. You crushed it.
Chad, I appreciate you. Thank you for having me.